3-week losing streak. As we mentioned, that's translated into lower prices at the pump for Americans. But can those declines keep coming? Joining us right now is Jeff Currie. He is Goldman Sachs Global Head of Commodities Research. And Jeff, we've talked with you pretty frequently about how you expect higher prices to return, that this is a temporary setback. I mean, these lower prices at this point are probably because of lower demand. What happens if we do go into a recession? Do you think that that could keep those higher prices at bay for quite some time?
Well, the lower prices are more a function of significant selling by investors. In fact, the financial markets and physical markets are telling you two very different stories. The financial markets are, hey, energy crisis, food crisis, inflation problem, done and finished. And in essence, investors are giving policymakers credit for things they haven't even done yet. And you can see this by looking at the shape of the oil curve. You look at the spot price, it's at call it $104 a barrel, something like that right now. You go up to the cash, it's trading at 112, 113. So it really hasn't done much in terms of this sell-off. You go one more out on the contract, it's $5 under. It's somewhere around $97, $98 a barrel. And that curve is just like a ski slope. The same thing on, inflation expectations or inflation break-evens. The 5-year is near 2%. The cash is at 9.1%. So I want to be really careful here that what you're saying, this big sell-off has been really concentrated in the financial markets and far less apparent in the physical markets. Yes, there has been some relief at the pump. Also, I want to point out at the gasoline demand weakness in the U.S., there's a lot of technical factors, such as, you have more ethanol in the gasoline pool this summer, but you look at other measures like mobility and things of that nature, they tell you gasoline demand is fine. So, we stick to our fundamental view, and it doesn't matter if it's European gas, which has come off as well, or oil, we still have very tight energy markets.
When will this show up in the financial markets, in the market that we watch so closely with WTI every day?
Well, I look at, here's what's amazing, and what I'm going to say applies to the equity markets and in the commodity equities and the commodity credit, is the arbitrage yield here is massive. Right now, if you think about this, if cash Brent is trading at, call it 104, and you go out on the curve, it's somewhere around 98, 99, that's a 5% roll yield if all else equal. So that's the arbitrage that's being opened up here, so that if the price stayed where it is, an investor can buy this and run it up, the convergence up to the higher price, which means it can't sit here like this for a very long time, particularly when the cash is trading even $10 higher.
So you're talking about a month's time before this has to catch up?
I'm shocked we're sitting here with, it's a 60% annualized return to be long that front end, and nothing happens with the oil price. Another way to say it, that oil price needs to drop 5% for a short position to break even just this 1 month, and would need to drop 60% over the course of a year to break even. So, and you look at the same thing with the equities. They're trading with multiples against their earnings that are like similar to the lows of the 08, 09 recession. Free cash flow yields in that 30+% range. So all of these instruments are severely depressed relative to the fundamental picture.
Well, Jeff, we just had a long conversation with Jared Bernstein from the White House about whether or not we're in a recession or about to be in a recession if you get 2 quarters in a row of a negative GDP print. Look, we can argue back and forth about that, but the reality is if we do go into a recession, you could see a downturn in demand, and that could last for a while. If that's the case, would that change your bull case scenario?
Absolutely, yes. I mean, commodities are the most pro-cyclical of all assets. You get a recession, they're going to get crushed. But the telltale sign, and you go back under every one of these cycles in commodities, that you're beginning to see the demand weakness is the front end of those curves weaken first, and then that spot price dips below the forward price. It means that the physical market is getting weaker than the financial market, and then they tip over. The fact that this thing is a ski slope going down like that, and the spot price is so strong up here, it's telling you that the physical market is still relatively robust, and that this recession concerns and this weakness is being primarily priced into the financial market. So what am I watching? The number one telltale sign throughout all the cycles in the last 3 decades of these markets you always watch that front end. And when that front end dips down below the forward price, that's when you start to get worried. But all of these commodity markets have very strong front end cash prices, which is telling the physical market's still in relatively good shape.
So where do you think WTI will be the end of the year? Has your target changed at all?
No, we still see, most upside in that late summer, early autumn, and then, on a Brent basis going back to somewhere around 125, sometime this at the end of this year. But I do want to emphasize, that's a long ways away from here, but the amount of liquidation in this market over the last 3 weeks is unprecedented. The total amount of investor money in all these commodities at the end of last week was $62 billion. That's like the size of a small company's market cap. They've liquidated everything they can get their hands on. And in some cases, in many of these markets, they're outright short, anticipating this recession that has yet to happen.
I guess if you're looking over the long haul, have you seen an increase in production? Have you seen an increase in anything that would make you think, okay, not just from the demand side of things, but potentially the supply side of things could get a little better?
Yeah, whether if it's in the weekly U.S. oil production numbers or you're looking at the rig counts that have been stagnant, the CapEx flows, FID around the world. I mean, you look at any measure of CapEx in any of these markets, and I'm not just talking about oil and gas, it's been essentially non-existent. And then you look at the food markets. The weather situation in Europe, is nothing short than disastrous given the heat wave. And then when you look at what's going on in the U.S., yes, we've had some reprieve in the weather more recently, but let's look at where those drought conditions exist. And we're not even into the thick of the growing season for soybeans. So you look across these markets, the supply situation is still very severely curtailed. Demand is still there. That's why markets are in deficit. Spot prices are sitting above forward prices, which is an indication of physical strength. And it means, you got upside risk until you finally start to see either more supply, less demand, which would appear as weakening in that forward curve, and we're just not seeing it.
So, Jeff, thanks. We'll talk to you. We will talk to you again soon. Thank you.
Great. Thanks for having me.